This is Professor Hazara again, and this is the fourth video here in the um, valuation of Pfizer, which is going to support your valuation of Lilly. Okay, and we'll go back to, I was looking at some other sheets here. Here's where we finished last time. We finished with our balance sheet, okay, and really what you should remember from the balance sheet is this plug number right here. So remember that current items are usually on the base formula, and also remember, I'm going to put this here again, is that for net property, plant, equipment, always use the base formula. So we'll say always use this formula here. Always take property, plant, equipment as a percentage of sales. That's what I'm saying. And then we'll be ready to start with our balance sheet. And once again, I'm going to put this in bold red and make big letters. Always use the base formula. Okay, for other non-current items, you can hold them constant, generally speaking, unless you know what's going in there. Because debt is a managerial decision as to how you're going to finance, not how you operate your business. Okay, which relates to sales. Anyway, so in this video, what we're going to do is, it should be a relatively short video, we'll see. But we're going to be looking, we're going to build what we call a schedule of assets. And we're going to build two calculations, schedule of assets, and then we're going to do our free cash flow. I'm not going to have you build a full statement of cash flows. It'll free cash flow to the firm level. And we're building the schedule of assets. It's going to be, it goes into the chapter on assets in a sense, but what we're going to do is we're going to use the schedule of assets as a basis for computing our free cash flows. And free cash flows, I'm going to do this just to keep this simple. I'm going to do it without the working capital adjustment, without the adjustments for current assets, current liabilities that you did on the statement of cash flows, with the working capital adjustment. Usually you would, but I'm trying to keep this basic because if I put in too much detail here, it can get confusing. But I just want you to get the concept down and have an idea of how this is done. Okay, so the schedule of assets, all I'm going to do is I'm going to take my gross assets for any 1 year. It's just like the assets. I'm going to take my gross assets, which are the assets before accumulated depreciation, gross property, plant, equipment. I'm going to take out my accumulated depreciation. That'll give me my net assets. And then down here, I'm going to compute, first of all, I'm going to put a couple of lines. I'm going to move this down a little bit here. And I'm going to compute a depreciation rate, which is, the depreciation rate is an approximation of how fast you are depreciating your assets. And that really goes back to whether you're using straight line or double declining balance depreciation, which you should have seen from the chapters, okay, and in my videos. Okay, so let's bring the years down because we're losing track of our dates down. So it may not be a bad idea to bring the years, these years, down to here. Okay, just so that we can keep our columns straight. Okay, and so we're going to start with the net assets for, this is our base year. So we'll start with our net assets here. Okay, and the place to get your net assets is from, let's see, go to the balance sheet. And this is going to be sort of a check figure. Your net assets for 2019 should be 13,967. Now, that gives you, that's equal to gross assets less accumulated depreciation. So you may want to ask yourself, where do you get those numbers from? Because I'm going to need not just the net assets, but also gross assets and accumulated depreciation to calculate that number. And we're going to need those to calculate our free cash flow down here. So the place you get those, and it's going to be the same thing for, it's going to be some worksheet on the right, which gives you the detail of all your assets for as of December 31st, 2019 in this case. Okay, so this is going to be a little bit of a hassle, but we're going to go all the way out here and look for sheets that say property, plant, equipment. And it's probably going to be in the second or the third sheet you find. Okay, so there's property, plant, equipment is the first one. And you usually get this. You usually get a bunch of text, and it starts telling you, it kind of tells you, you could actually, might be able to pull it from here, but notice that it tells you that as of December 31st years 2019, 2018, they give you the land, the buildings, and all this stuff. And it gives you accumulated depreciation. So you could get it from there, and notice it says 13,967. So you do get it from there. You could pull the information from here. That might be a little bit. You have to read into it sometimes. It usually equals, but sometimes you'd rather have a table. You'd rather have a calculation. And the calculation is usually in a second or third sheet way out to the right, which gives you how you got that 13,967. So let's keep going out. We're actually going down the balance sheet, then we'll start again and go back down the balance sheet. Look, there's another. Here's the second one. And you get a second one here that gives you more. Basically repeating the same thing. This is probably for the consolidated amount. I don't know why they're giving it twice here. But you usually get a couple of tables with text. But usually the second or third table, let's go out here a little more. Let's see what we get here. The base hassle around. I think we are going to get it pretty soon because we're going back down the balance sheet again. Oh, financial instruments. Okay. Just a minute. It's this one right here. There's your table right there. That's the table I'm looking for. And Lily's probably going to be the same thing. They're not exactly alike, folks. So, yeah. But this is telling you how they got their gross assets were 30,756, less the accumulated depreciation was 16,789, and there's that 13,967. So that's your gross assets and your accumulated depreciation, because they equal the net assets of the balance sheet. Okay, so I'm just going to go ahead and copy those two numbers over to this little table that I'm making here, going all the way back here. You'd like to see them in table form because the text can sometimes be confusing. Notice how far out. Notice how many sheets you get. 10K. Okay, so let's see what you got here. Pro forma valuation. There it is. So let's go ahead and put those numbers in there. Okay, now what we're going to need finally, before we fill this in, finish filling this in, the depreciation rate. And that basically is the easiest way to get that. And that's the rate at which we're depreciating our assets. And we're just going to do a quick calculation based on the 2019 rate. We're going to take our depreciation expense and divide it by our gross assets and get our depreciation rate. It's going to be a percentage. So we need our 2019 depreciation expense. And by now you should realize, after having taken the midterm or anything, that you always find depreciation expense on your statement of cash flows. So notice it's going to say here depreciation and amortization. For my purposes, it's fine. That probably also includes the amortization of the intangibles, but I don't want to deal with that. So keep things simple. So depreciation and amortization. Your depreciation rate is going to be from, you're going to take your depreciation expense and divide it by your gross assets. So you're depreciating about 20% per year of assets, which is, if your assets have, you're saying your average assets have a 5-year life. Probably be a little bit lower than that. Or a little bit lower because you throw out your amortization, but that's okay. I'm just getting into about 20% per year. Okay, so we're going to finish this table in here. We're going to finish this table. What we're going to do is we are going to, first thing you do is we're going to fill in we're going to work backwards. This is like working backwards using the 3/4 rule through the D accounts. You're kind of doing that actually here. We're going to take our net assets and then we're going to work backwards to get our accumulated depreciation and our gross assets. Where you get your net assets from? That's exactly what I got, where I got them from before. You're going to get them from the balance sheet up top. So you'll notice that all these numbers here are equal to the row 57, and if you go back up to row 57, you'll see that that's my net assets. And by the way, that's why what I'm about to hear, that's why I use the base formula for that. Okay, so I use my net assets. How do I get my accumulated depreciation? Well, accumulated depreciation should be your beginning depreciation plus your current year's depreciation expense. It's kind of like the 3/4 rule. So what we're doing it maybe a 2/3 rule. So what you're going to do is you're going to take your gross, you're going to take your beginning accumulated depreciation and add to that depreciation expense, which is your gross assets times your depreciation rate. So you're just taking your beginning accumulated depreciation, adding depreciation expense for 2020, which would be your beginning gross assets times the 20% more or less depreciation rate. So your new accumulated depreciation is that number right there. And then in order to get your new gross assets, what you're going to do is just take your net assets and add to that your new accumulated depreciation. And that gives you your new gross assets. And so just to review, accumulated depreciation, I'll give you the sheet. The accumulated depreciation is, this is your beginning, I'm going to look at the formula thing here, your beginning accumulated depreciation plus your gross assets times your depreciation rate. Okay, and then your gross assets are just the sum of your net assets and your accumulated depreciation. And then after that, you've got to freeze this depreciation rate here, the C99 cell, because we're going to copy across. So go ahead and freeze that number in. Then you can just copy across, and you should get legitimate numbers there. And let's go ahead and format this because that looks a little bit out of slack, but it looks correct. The numbers look correct. So let's go ahead and format those. Currency with 0. Those look pretty good. And in a sense, I'm going to put line there because in a sense that's a subtotal. It's not, we didn't calculate it that way, but in a sense, your gross assets less your accumulated depreciation equal that number. I'm just going to check this here, make sure that my results turn out good. The number checks, so that's good. Okay, now we're going to go down and calculate free cash flow. We're going to do it without making the adjustments for current assets, current liabilities, netting those out like you did on the statement of cash flow. So I'm going to keep this simple. So I'm just going to go with let's use net income. Yeah, we'll use net income. Be slightly off there, especially since the company has so much interest expense, but we'll leave it out and we'll keep this simple. Keep in mind what the definition of free cash flow is. Free cash flow is the income or the cash that's left over. We'll assume that net income is equal to your cash flows from operations. So we're going to take our net income, and it's going to give us a very rough estimate. And we're going to add back depreciation expense and take out our capital expenditures. And that should give us, by taking out capital expenditures, that should give us, those are your investments for growth rates. So as you're taking that income, add back your depreciation expense, which is a really huge non-cash expense, and take out your capital expenditures. That should give you a really rough estimate of your free cash flow that is available to pay dividends and interest after you've reinvested in those capital, in your investments in property, plant, equipment. And that's what we mean by investments for future growth, is investments in assets. In this case, R&D too, but those are adjustments I'll make in the future. So your net income, you're going to bring your net income down from your income statement. Easiest place, just copy, bring it down, bring it over. So net income is, this is a very rough estimate of this. I usually wouldn't take the net income directly, but I'd make some adjustments for it, but I'm not going to. Okay, and let's put, why don't we bring the dates in here? Bring the dates out here just so that we know what dates we're dealing with. And all we're going to do is add back, I'm going to add back depreciation expense and take out accumulated, what am I doing? Take out purchases of property, plant, equipment. And that should give me some idea of the cash that that I'm going to have left over after I've invested my PP&E that I have left over to pay dividends and interest. The one thing for a company like this is you probably consider R&D too, but that's more conceptual. Um, your depreciation expense. How do we get depreciation expense? Well, we don't need it for 2019 because we've got 5 years here which we're going to discount in our final valuation. So the depreciation expense, if you remember, all you've got to do is take the difference between accumulated depreciation for 1 year and the accumulated depreciation for next. So your depreciation expense is this, the difference in your accumulated depreciation numbers for any one of these years. That's why we did that schedule of assets. And what are the purchases of property, plant, equipment? Those are just the differences in your gross assets. So in a sense, these are net purchases after having sold something. You know, we're taking these. We're doing this as a very rough calculation, and these, by the way, has to be negative. So go ahead and put this in parentheses and negative sign there. So these should be negative. So you're depreciating that amount, you're pushing that on. These numbers actually aren't bad because if you notice, this company's not growing very fast. And if a company is growing fast, then the purchases of property, plant, and equipment should be way larger than your depreciation expense. Whereas if a company is growing slowly, purchase of property, plant, and equipment should be not much higher than your depreciation expense. If you're going to grow fast, you're going to buy tons of fixed assets, and and you'll be depreciating at some rate, but you'll be purchasing your investments in fixed assets at a much higher rate than you're depreciating them because you're expecting future growth. So this kind of makes sense. This does make a little bit of sense conceptually. Then this will give us our free cash flow to the firm. Now, this, like I keep repeating, is such a rough calculation because there's usually adjustments that you make for taxes, for the interest net of taxes, and also for the working capital. But I'm just going, this is just a very rough calculation, and just add these numbers up. So that's going to give us high free cash flow, and it is high. And I just want to show you something is that notice how income is dominating free cash flow. Notice that income, that the free cash flow is equal almost to net income. And why is that? That's because you're not purchasing a lot of property, plant, equipment. If you were purchasing a lot of property, plant, equipment, that would be driving the cash available, your free cash flow available to pay dividends, interest down. So the reason that this company, Pfizer, has such high free cash flow is number one, it has high gross margins. Those gross margins are invested, produced, it's got 8% gross margin we saw. So it's got a lot of cash, but it's not buying a lot of property, plant, equipment because it's not growing that fast. You have to look at R&D here too, make adjustments for R&D, but we won't do that here. And so you've got some high free cash flow, but it's growing slowly. So there's, in a very general sense, this does depict Pfizer. It's a high cash flow company, which is growing slowly, and the slow growth is shown in fact that depreciation, that property, plant, and equipment is not much larger than your depreciation. So you are investing, but you're investing at a rate which is just a bit higher than the rate at which you're depreciating. So if you were investing a lot more at amounts that were a lot higher than depreciation, you would be growing at a lot higher rate, or you would expect to anyway. So, okay, so I'll leave this here, and the final video is going to be actually the quickest one. It's going to be the final calculation of the price, which, by the way, since we already have a template for that, so that's going to make that quick. Thank you very much, and I'll put this up.